Good day, doctor. I'm Jayalashmi Venkataramana. Metric number is 289717. I'll be presenting a comprehensive investment analysis on Amway Holdings Berhad, a well-established direct selling company in Malaysia. It is incorporated in 1976 and listed on Bursa Malaysia in 1996. Amway Malaysia is a subsidiary of the Global Amway Corporation, which the headquarters in the United States. The company specializes in health supplements, beauty products, home care, and personal wellness, and it operates primarily through a network of ABOs who drive sales directly to consumers. Amway's business model focuses on relationship-based selling, high brand loyalty, and repeat consumption, which helps maintain steady cash flows despite economic fluctuations. Next, we will look at the economic analysis of Amway Holdings Berhad. During the trading and analysis period, the Malaysian economy was navigating a post-pandemic recovery phase with growth supported by domestic demand, but challenged by global inflation, rising interest rates, and currency fluctuations. Inflation remained a concern in early 2025, impacting consumer purchasing power, especially in non-essential spending categories. This directly affects companies in the direct selling sector, where products can be seen as premium or discretionary. Despite this, Malaysia's unemployment rate remained low and household income was relatively stable, especially among the urban middle class, which is Amway's primary customer base. The government's emphasis on Bumiputra entrepreneurship and small business incentives indirectly benefits Amway's distributor model by encouraging self-employment and micro-business participation. While the macroeconomic environment was not strongly expansionary, it was stable enough to support consistent demand in health, wellness, and household products. Followed by industry analysis. Amway operates in Malaysia's direct selling industry, which includes health, wellness, and personal care products. This industry is regulated under Malaysia's Direct Sales Act, making it transparent and consumer trusted. Demand has remained resilient, especially post-COVID, with people focusing more on health and hygiene. Amway benefits from long-standing brand trust, strong distributor networks, and repeat purchase products. However, the industry faces challenges from e-commerce platforms like Shopee and Lazada, offering cheaper and faster options. To stay competitive, Amway uses a hybrid model, combining traditional personal selling with online tools for better customer reach. It also supports micro-entrepreneurs, which aligns with national goals to boost self-employment and small business growth. Overall, the industry remains viable and competitive, especially for companies like Amway that adapt to digital trends. Here is a summary of Amway's SWOT analysis, focusing on 4 key factors that impact its performance and growth potential. Starting with strengths, Amway has a strong global brand reputation with decades of consumer trust. This brand loyalty gives it a competitive edge, especially in health and wellness. Another major strength is its high dividend payout ratio, which consistently rewards investors and makes the stock appealing for long-term, income-focused portfolios. Next, the weaknesses Amway faces is declining sales revenue over the past few years. Despite strong profit margins, this drop in sales shows weaker demand or competition. Also, the business model relies heavily on its distributor network, so any disruption to that system could affect the performance. Now for opportunities, Amway is well positioned to benefit from rising health awareness, especially after the pandemic. More people are focusing on supplements and wellness products, which is Amway's core strength. There is also room for growth through digital tools and hybrid selling models, which can help expand its reach beyond traditional direct selling. And finally, threats. Amway faces strong competition from e-commerce platforms like Shopee and Lazada, which offer convenience and lower prices. Another concern is its aging distributor base. If younger people don't join the network, future growth could be limited.
Petronas Gas Berhad, established in 1983 and listed on Bursa Malaysia in 1995, is a key subsidiary of Petronas, Malaysia's national oil and gas corporation. As an essential part of the nation's energy structure, the company operates in gas processing, pipeline transportation, LNG regasification, and utility supply to industrial customers. Focus on strategic infrastructure investments, Petronas Gas is also driving clean energy innovation and sustainability, supporting Malaysia's progress toward a greener future. Next is economic analysis. For the monetary policy, changes in interest rates will affect its financing costs. For the fiscal policy, tax incentives support the profitability. However, carbon taxes and subsidy cuts will increase the operational expenses. Other economic factors like geopolitical tensions, inflation, and a weaker ringgit further increase the costs. In response, it is investing in renewable energy and carbon capture technologies while expanding into Asia to support regional energy transition and long-term sustainability. Petronas Gas Berhad was under Petronas to develop Malaysia's gas infrastructure. It has since played an important role in gas processing, transmission and utility supply to support national energy needs and industrial growth. The oil and gas industry matured Petronas Gas evolved into a leading midstream operator backed by long-term contracts and steady cash flows. In response to the global energy transition, the company is now embracing digital transformation, carbon capture, and hydrogen technologies. Today, Petronas Gas remains a cornerstone of Malaysia's energy landscape, contributing to strategic projects like rapid and LNG terminals while actively preparing for a sustainable low-carbon future. Next is SWOT analysis. Strengths include strong backing from Petronas and control over critical gas infrastructure, ensuring the stable profits. However, weaknesses lie in its reliance on fossil fuels and aging assets, which pose cost and flexibility challenge. Opportunities arise from growing LNG demand and clean energy initiatives, opening paths for innovation. Threats like renewable competition, tighter regulation, and market volatility could impact the long-term success.
Assalamualaikum and good day, Doctor and everyone. My name is Fatina Bila binti Muhammad Zaidin, metric number 295266. Today, I will be presenting for LPI Capital Berhad, a leading investment holding company in Malaysia, primarily known as for its general insurance business through Lamport Insurance Berhad. So let's get started with who is LPI Capital Berhad. So LPI Capital has a rich history established in 1962 and listed on Bursa Malaysia in 1988. They are a well-respected and profitable player in Malaysian insurance sector. What's crucial to understand is their strong connections to the public bank group. This is the strategy partnership will give them a significant competitive edge, especially in distributing and market rank. From an economy perspective, LPI is well positioned. Government fiscal policies like corporate tax rates rarely impact their profitability. Lower tax mean more profit for shareholders or reinvestment. So for monetary policies for Bank Negara Malaysia, particularly interest rates influence both their borrowing cost and investment return. However, LPI can skillfully balance this factor. Other economic influence like inflation and consumer spending. The Malaysia insurance industry is in major growth phase. This means steady, not explosive growth. LPI thrive here due to established player, stable regulation, and increasing consumer awareness, while technological advancement and insurtech are pushing the industry toward digital transformations. LPI's competitive position is robust. Their association with public bank provide an parallel distribution network and built-in customer trust. They prioritize underwriting profitability, avoiding aggressive price war. Their financial strength. So now let's look at the financial health of LPI. For the liquidity ratio, their liquidity ratio have slightly declined. They remain robust, indicating a strong ability to meet short-term obligations. Their receivable turnover is improving, meaning they are very efficient at collecting premiums. And critically, their debt ratio are consistently decreasing, showing a healthier, more conservative capital structure and reduced reliance debt. This is a very positive sign of financial stability. And for the profitability ratio, their net profit margin, return on asset, and return on equity have all shown strong and consistent improvement. LPI is becoming more efficient at converting revenue into profit and generating returns for shareholders. And for the earning per share have grown steadily. They maintain a high dividend payout ratio, demonstrating a commitment to rewarding shareholders. And the last one is the price to earnings ratio has become more conservative. But this brings us to the exciting part. Our fundamental analysis indicate that LPI Capital Berhad has an intrinsic value of 14 ringgit 53 cent. This is currently higher than its market price of 14 ringgit 32 franc. First, the MACD shows the momentum turned bearish after a short-lived bullish signal in late May. Since 6 June, it's been trending down with red histogram bar, indicating caution and consolidation. Next, the RSI has stayed mostly below 40, hovering near 30 around 10 June. That suggests weak momentum, but not strong enough to call it oversold or signal as reversal. The moving average tells a similar story. The 9 days SRM crossed below the 20 and 50 days lines after 6 June, classic bearish crossover, hinting at downtrend and investor caution. Lastly, the chart shows key support at 14 ringgit 78 cent and resistance at 15 ringgit 8 cent. A break of either could trigger strong moves as they reflect investor physiology.
A very good afternoon. Myself, Jasmine Sundar, and my matrix number is 297546. The company I chosen is Sunway Berhad. So Sunway Berhad is a public listed company where the company has diversified business portfolio across the several main factors such as portfolio development, construction, healthcare, education, hospitality, and so on. The company established on 1974 by Tan Sri Dr. Jeffrey Chia. So basically, the Sunway Berhad company has grown as a small-time mining company. Now they are turning into biggest and most reputable public listed company in Malaysia. The headquarters of the company is actually located in Bandar Sunway, Selangor. So Bandar Sunway is one of the most Malaysia's first successful smart and sustainable township. So let's be focused on into economic analysis. So in the main factors, monetary policy, Bank Negara Malaysia maintains the overnight policy rate which known as OPR at 3% to keep borrowing costs moderate. This really support the Sunway expansion in terms of property, construction, healthcare by lowering their financial costs. Do the Sunway Berhad will face the risk? Of course, yes. If the interest rate is higher, the borrowing becomes more costlier. It would slowing the property sales and project rollout. Under the fiscal policy, the government's budget 2025 really supports in term healthcare, affordable housing and infrastructure. The Sunway also benefits from tax incentives from green buildings and sustainability boosting ESG and profitability. Other economic factors is low unemployment. From the data we searched is 3.2% only in Malaysia we having unemployment issues. So it's really boosts our consumer confidence to spend their money. The factors like currency fluctuation may cause a weak ringgit Malaysia. It can raises the cost of imported materials, medical equipment, and other affected projects using the USD contracts. So basically, Sunway Berhad operates in multiple industries like property, construction, healthcare, education, hospitality, and retail. So this diversification really helps the company to balance between the mature industries with the stable income and also their high growth sectors with future potential. In terms of property and construction are the mature stage in Malaysia, where there has the stable demand in cities, but they also do facing the challenges like rising costs, strict loans, and the oversupply affect growth. Healthcare and education are in the growth phase. This is due Malaysia's aging population, more people caring about their health, and rising demands for the quality private hospitality and retail are recovering after the pandemic. This recovery is led by more tourism, domestic travel, and stronger consumer confidence. The competitive advantage of Sunway Berhad is they has their strong brand and experience. They run their business over 20 years of experience in property and construction. They're also known as integrated township like Sunway City. Healthcare and education leadership. They own a Sunway Medical Center and Sunway University, also known as quality and innovation. Other than that, they also earning in retail and hospitality age and also portfolio and integration strength.
Good day, doctor. My name is Teo Yi Hui, matrix number 2937745. Today, I'm going to present about KBJ Healthcare Berhad, which is a leader in private healthcare across Malaysia. Founded in 1981, KBJ Healthcare has grown from Johor as the first private hospital with 29 hospitals in Malaysia and international facilities in Thailand, Bangladesh, and Australia. KBJ is committed to world-class care. Headquartered in Kuala Lumpur, it's been public listed on Bursa Malaysia since 2017. KBJ's strength lies in comprehensive service at specialist hospital, ambulatory care, and wellness center. They excel in cardiology, oncology, orthopedics, and women's and children's health. KBJ focused on preventive healthcare through screening and wellness program, ensuring patients stay healthy and proactively. KBJ keep improving in this rapid change era, from e-pharmacy to AI and robotics. They are digitizing healthcare. Their KPJ Healthcare University College trains the next generation of medical professionals, while KPJ Senior Living Care address the need of aging population. This forward-thinking approach ensures long-term growth and relevance. In 2024, their rehabilitation center won the Global Health Asia Pacific Award. It's a proof of their excellence in sport, rehab, and physiotherapies. In last year, KPJ also unveiled a modernized brand identity, reflecting its evolution while staying true to the core value, which is true and compassion. Next, I will discuss how economic policies and macroeconomic factors impact KPJ Healthcare Berhad. First, monetary policy. Bank negara interest rate decision will directly affect KPJ revenues. For example, if OPR rise, KPJ loans for hospital expansion become higher and squeezing the profit. Higher rate also means patients have less disposable income for elective treatment like health screening. Conversely, the current low OPR of 3% help KBJ borrow affordable and benefit from stronger consumer spending. In short, interest rates should boost KPJ's cost and patient demand. Next, fiscal policy. The government healthcare budget like RM41.2 billion allocated in 2024 could transfer patients to public hospital, reducing KBJ revenue for basic treatment. The tax incentive for medical tourism helped KBJ attract wealthy international patients to its premier hospital. However, stricter price control on private healthcare fees could limit KBJ's ability to pass on rising costs, hurting margin. When Malaysia's GDP grows highly, the middle class has more disposable income. This will directly benefit KBJ as patients can afford more premium treatment. Moving on, when inflation rate and consumer price index rise, will lead KBJ to face higher costs across the board. Cabbage's story began in 1981 with its first hospital in Johor. This decade was about laying roots, establishing trust and expecting to major city with reliable basic healthcare service. Then, in the year 1990 to year 2000, was Cabbage's hyper-growth phase. It acquired hospitals like Tawakal, expanded into Indonesia and Thailand, and invested in specialties like cardiology, becoming a regional leader. In recent years, Cabbage pivoted to smart growth, digital tools, professional specialties, and medical tourism. Think AI diagnostic and attracting international patients. Today, Cabbage balances innovation with sustainable goals, exploring new market carefully while maintaining its premium reputation. Now, let's examine Cabbage's current strategy position through a SWOT analysis. Cabbage's greatest strengths are its market leadership and reputation. As Malaysia's largest private hospital network with flagship facilities like KPJ Damansara, they enjoy strong brand recognition and trust. This gives them a competitive advantage to attracting both patients and top medical talents. However, KPJ face some challenge. Their premium service come at higher cost compared to government hospital. Additionally, maintaining advanced technology and paying specialist salary create significant operation expenses that pressure profit margin. Looking externally, two major opportunities stand out. First, Malaysia's aging population and rising chronic disease create growing demand for private healthcare. Second, the global medical tourism market presents huge potential, especially with government support through tax incentives. But we must also consider threat. Increasing healthcare regulation and potential price control could limit capital pricing flexibility. Economic downturns may also reduce patient affordability for private healthcare service.
So, for conclusion, let's start with comparison in terms of financial condition and operating result. So, let's begin with the liquidity ratio. So, as we can see, among the 5 companies, Petronas Gas Berhad stand out with consistently strong current quick and cash ratio, making it the most financially secure in term the short term, ideal for conservative investor. So for LPI Capital Berhad also shows solid liquidity, though its declining cash ratio suggesting increasing resilience on less liquid asset. Amway Holding Berhad demonstrate a positive trend, improving steadily in most liquidity measures, making it attractive for growth-oriented investor. Meanwhile, Sunway Berhad and KPJ Healthy Berhad stayed with low liquidity but have made visible progress, though they are still present higher short-term risk. Moving to activity ratio, Amway Holding Berhad leads in asset efficiency, especially in receivables. Petronas Gas Berhad excels in inventory turnover, reflecting strong stock management, and LPI Capital Berhad show balance and improving activity metrics. KPJ Healthcare Berhad improved across the board, indicating better operational control. Meanwhile, for Sunway Berhad show a gradual improvement, but still lacks in inventory efficiency. Okay, for the third one is leverage ratio. So, for the leverage ratio, Petronas Gas Berhad again proved the most conservative with the lowest debt levels. Amway Holding Berhad has significantly reduced its leverage, showing strong financial disciplines. LPI Capital Berhad and Sunway Berhad maintain moderate level of debt, while the KPJ Healthcare Berhad remains the most leveraged, though it making a progress.
This is the table showing the overall result of the profitability ratios for the 5 companies among the 3 years. Here is the graph showing three ratios that we obtain in the profitability ratios. Based on the graph, we can conclude that although Amway Holding Berhad obtained the lowest net profit margin, but they're able to manage the assets and shareholder equity well, where they're able to generate highest profit by using the equity and assets among the five companies. For Petronas Gas Berhad, they are able to obtain the highest net profit margin, but have moderate performance in generating revenue using the company's equity and assets. Then, LPI capital performance for the overall profitability ratios is considered moderate. For Sunway Berhad, they have the lowest ROE and ROA, indicate the company is not able to use the equity and assets wisely. In the net profit margin, they have a moderate performance which is the same as LPI Capital Berhad. For the KBJ Healthcare Berhad, the profitability ratios overall does not perform as moderate as LPI Capital Berhad, but not the worst company among the five companies. In summary, each ratio for every company show increasing as time increase, which we can conclude all the company have the well performance in generating profit after the post-pandemic period and see is back to the track. This is the table showing the result of common stock ratios for the overall performance for the five companies among the 3 years. Based on these three graphs showing the common stock ratios, we can conclude that in the earning per share ratios, KBJ Healthcare Berhad obtained the lowest among the five companies. Conversely, Petronas Gas Berhad obtained the highest in 3 years. Based on the overall performance, LPI Capital demonstrate the most impressive EPS growth from 2022 to 2024. EPS for Amway Holding Berhad, Petronas Gas Berhad, and LPI Capital Berhad from 2022 to 2024 is influenced by the company's operating revenue because the number of shares for these companies has been maintained for 3 years. On the other hand, the value of EPS achieved by Sunway Berhad and KBJ Healthcare Berhad is affected by the number of shares where the company allocate each year and the revenue of the companies. For the dividend payout ratio, Petronas Gas and LPI Capital present the healthiest dividend policy, where Amway approach appear risky, Sunway favors growth over income, and KBJ Healthcare Berhad remain underwhelming due to the fundamental weakness. For the price to earning ratios, Amway obtained the lowest PE ratios. Petronas Gas have the moderate performance in PE ratios. LPI Capital offer the most attractive valuation growth combination, and Sunway provide a high growth expectation. For KBJ Healthcare Berhad, the stock was categorized as overpriced in the market, where investors should consider other factors before purchasing it.
This table shows a direct comparison between each company's intrinsic value, which we calculated based on forecasted EPS and average PE ratio, and their actual market price. Starting with Amway, the intrinsic value for 2025 is 4 ringgit 53 cent, while the market price is 4 ringgit 92 cent. This means the stock is trading close to its fair value with very minimal overpricing. It suggests market pricing is in line with the company's financial strength and dividend stability. For Petronas Gas Berhad, the intrinsic value is 18 ringgit 72 cent, which is higher than its current price of 17 ringgit 70 cent. This indicates that the stock is undervalued. The market has not fully priced in its strong earnings, stable contracts, and low risk profile. LPI Capital Berhad also shows undervaluation with an intrinsic value of 14 ringgit 53 cent compared to a market price of 14 ringgit 32 cent. The difference is small but still positive, suggesting the market may be slightly discounting the company's strong fundamentals and consistent dividend track record. In the case of Sunway, the intrinsic value is 4 ringgit 37 cent while its market price is 4 ringgit 66 cent. This makes it slightly overvalued, possibly due to investor optimism in Sunway's growth segments like digital, healthcare, and property. It is not risky, but it suggests the stock may already be fully priced. Lastly, KBJ Healthcare Berhad shows the largest gap. Its intrinsic value is 2 ringgit 7 cent while the market price is 2 ringgit 58 cent. This means the stock is overvalued, likely because the market is pricing in future growth from medical tourism and private hospital expansion. But those gains are not yet reflected in the earnings. That's all from me. Thank you.
Next is comparison in terms of technical analysis. First is MACD. The MACD of Amway Malaysia Holdings Berhad, Petronas Gas Berhad, LPI Capital Berhad, Sunway Berhad, and KBJ Healthcare Berhad has shown different momentum patterns and trend direction. Sunway Berhad showed the clearest bullish signal in early June with the strong MACD signal shown by the crossover and price rebound. However, the MACD line and histogram are now showing recent weakening, indicating that the uptrend could be losing momentum. If Sunway Berhad's price can break above Ringgit Malaysia 4.85 with significant volume, it could continue its bullish moves higher. Otherwise, if a MACD crossover or the price breaks below Ringgit Malaysia 4.80, this could signal the end of this upward movement. At the same time, Petronas Gas Berhad indicated the clearest bearish trend with the two MACD lines below the zero line, red histogram bars expanding, and a breakdown of price support. This shows a clear selling pressure with weakness in the market. On the other hand, Amway Holdings Berhad, LPI Capital Berhad, and KBJ Healthcare Berhad are all in neutral and consolidation states with not clear direction signals. For the investor in that group, especially Amway and LPI, it is advisable to wait for a confirmed MACD crossover above the zero line with volume before entering into a new position. Second is Relative Strength Index RSI. The RSI of Amway, Petronas Gas, LPI, Sunway, and KBJ Healthcare has shown different momentum patterns and investor sentiment. Sunway perhaps is the most technically bullish stock as it has RSI level above 50 who in the past have reached overbought levels in its RSI, indicating that it still has a bullish trend. However, the current RSI consolidation near resistance shows a level of uncertainty, and a break above resistance with volume would further signal bullish continuity. Amway and LPI would be classified near the neutral basis sentiment, with weak bullish or bearish momentum with RSI levels still remaining below 50, pointing the indecision or consolidation. Petronas Gas is attempting to recover above the oversold RSI level stock, but ultimately its RSI level have continued to remain below the 50 to have strong confirmations of a stock reversal. KBJ Healthcare is still showing the weakest momentum due to its RSI level consistently below 50 and going even lower in its recent RSI, indicating that its stock price remains bearish pressure. Overall, the traders need to be patient, avoid from making premature entries, and monitor RSI breakouts through 50 with volume as potential signal of trend strength or reversal, especially in Sunway. Petronas Gas and KBJ Healthcare should be administered with caution until the clear signs of recovery.
Now I'll conclude the technical analysis by comparing all 5 stocks using the 2 indicators, which is moving averages and support and resistance levels. So basically, as shown in the graph, where the Sunway shows a strong bullish trend, it formed a golden cross where the short-term moving average. Compared to the Petronas company, it formed a death cross where it showed a clear bearish sign. When the ME company is actually bearish to neutral, where the MA is still bearish with the 9-day EMA below the 50 days of SMA. However, the EMA flattening, which may signal a possible reversal if there is a volume breakout. So the LPI Capital company is actually mixed, where they showed short-term bullish sign, but it has now turned sideways. KPH Healthcare company, it's actually moving average are very close and flat, showing no clear trend. It remains like a neutral zone. So let's look at the support and resistance. So Sunway continues to hold support at 4.77 Ringgit to 4.80 Ringgit and is now testing resistance at 4.87 Ringgit. So compared to the Petronas Gas company has broken its support where at 17.50 Ringgit and now struggle at 18.28 Ringgit resistance. As the graph shown, the Amway company is actually stuck at range between 4.90 Ringgit and 5.10 Ringgit. There is no clear breakout yet. So LPI company, it's actually there has a previous support at 14.78 Ringgit has now become resistance. When it's compared to the KPJ Healthcare, they has trading tightly between the 2.66 Ringgit and 2.73 Ringgit, where they keep getting rejected as resistance. In a summary, Sunway Berhad stands out with a clear bullish pattern across all levels. The other 4 stocks remain in neutral or bearish zone, so the other investors should wait for the confirmation before taking action. That's all from us. Thank you.